Hello everyone. Welcome to Breaking Down series of Investrance Research where we break down a lot of things related to finance, stock market, investments and economics. Today we are going to break down very important organization in the country, that is Reserve Bank of India, which manages and supplies money in the country. Okay, like RBI, which manages all the economic indicators that you hear in your day-to-day life. Other countries as well has certain central banks in them. Like China has People Bank of China. US has Federal Reserve Bank, Europe has European Central Bank, and then there is Bank of Japan and Bank of England. So there are certain key objectives that RBI has to follow, because in the economy there can't be with in terms of money I'll be talking. uh, Things can't be too pricey in the sense too high price and too low price, right? It has to maintain and balance that kind of uh, you can say equilibrium, just to manage the economy. So it does. You have a lot of times you might have heard about inflation, that inflation is high, low. So according to that, RBI has certain tools and policies using which it maintains and manages the economy. Okay, the main motive is to maintain the level of money in the economy. Okay, so RBI releases its monetary policy twice a year to stabilize the economy. Then there are certain RBI objectives, that is uh, giving it a maximum feasible output, high rate of growth. Every country like China has 7% growth rate. India also is at 7% right now, but every country needs to be having a high rate of growth. How this high rate of growth can be achieved is by if you supply uh, heavy money in the economy, obviously then the value of money and the things gets cheaper, right? So this money will be used by businesses and industries to flourish, and then there will be certain development in the country which will lead to high demand and high growth, which will indirectly relates to the stock market, because due to high demand the businesses will be doing good and the company stock prices will rise. Okay, then RBI's objective is a fuller employment. Obviously if you are supplying money, then if there is higher demand, so every game is of demand and supply that takes place in an economy. So there will be high demand for employment, right? Because industries need to be making more goods and products. Then there has to be price stability. So as I mentioned, things can't be too high priced and things can't be too low priced. So there has to be kind of equilibrium that has to be maintained, which RBI does. And then there is income distribution, which has to be equal. So that's why there are tax slabs based on your income. And also why demonetization happened, because there was a lot of black money that has been supplied in the economy, so that was making richer more rich and poorer more poor. So that has also had to be cut down. That's why RBI came with a solution that okay, let's change the currency, like so that black money doesn't come back, right? And then there are balance of payment. So balance of payment is nothing but a balance between imports and exports. So what happens generally, if we import a lot of goods from other country, that means that we are paying them in Indian rupees. So that means what, a lot of our currency is going out of the country, right? So that should not be happen. Every country which is developed should be an export surplus. That means what, you are taking other countries currency, like obviously we are, when we are exporting, we are taking US dollars, other euro currency and other currency. So there has to be certain balance of payment that has to be maintained, so that if a lot of our currency goes out, then other countries has the power to do a lot of things in our country, because our currency value will be decreasing. So and in though RBI has a right of printing money, they can't go on keep on printing money, because it will decrease the value. Whenever it prints money, it has to give certain securities in the form of say gold, and then now they are selling treasury bills so that they can print money. Okay, then they later buy back this gold or treasury bills. So it has certain economic impact, and which is related to stock market that happens, right? So let's see what are those tools and policies that RBI has. So there are certain policies that is in the form of quantitative, that is traditional method, and qualitative and selective. The much heard news will be about the quantitative measures. So quantitative measures are the measures which regulate the volume of the total credit, and qualitative will be regulating the flow of credit. So quantitative measures include bank rate policy, open market operations, cash reserve ratio, statutory liquidity ratio. And quantitative, which all this bank rate policy, open market, and cash reserve and SLR, you might be hearing quite frequently in news channels, which are very important. And then there are quality measures like designing the guidelines, then direct actions, then rationing of credit, margin requirements. So certain qualitative measures that RBI takes. Okay, so uh, uh, let's learn about this measures in detail. So and then there is cash reserve ratio, which is one of the quantitative measures, which says that there's certain percentage of bank deposit that has to be kept in current account with RBI. So whenever you deposit or other people deposit their money in the bank, so bank has to uh, yeah, take the certain percentage of money. So all these are in percentage. Suppose say you have kept 1 lakh rupees and RBI says that now 4% is the CRR. So you need to keep 4,000 with me. So why this CRR, cash reserve ratio, statutory liquidity ratio, is because it exists is because there will be certain contingency time or crisis time. So bank should be safe, right? So it's for the safeguarding. It's that like you don't invest 100% of your money into portfolio of equities. You also invest in debt and safe investments, right? Just to safeguard yourself. So similarly, there are CRR and SLR. So what happens when the cash reserve ratio increases or decreases? Uh, so if obviously if the CRR is increased, say 4% to 6%, that means what now when you were keeping out of 1 lakh deposit, when you were keeping 4,000, now you have to keep 6,000. That means what now take it as a broader terms, think imagine in a broader terms that there will be less money that will be given to people in the economy for development and other purposes, right? So the money availability is less. Okay, so let's get back when it is decreased. Obviously, there will be more money. Suppose say CRR goes to 3% or 2%. Now, whenever the 1 lakh is deposited, you have to keep just 2,000. So rest of the money, the banks can be giving it to the businesses for developing the economy. So why these tools are used? To increase or decrease the money supply in the economy. If things are too high priced and inflation is going up, so what RBI will do? RBI will increase this CRR, SLR, bank rates and repo rates or reverse repo rates, so that the money supply gets cut down and things gets very high, less demand takes place and the money supply is decreased. So because they have to maintain an equilibrium or balance in the economy. Okay, then there is statutory liquidity ratio. So bank needs to keep certain percentage of money with itself, right? So the SLR currently is at 20%. So for the 1 lakh deposited, bank has to keep 20,000 with itself. Okay, then the rest of the money, rest of the after the SLR and CRR, the bank can give rest of the money. So whenever you deposit that money, obviously it goes to certain bank loans or car loans, and bank earns certain rate of interest on that, right? So bank has to maintain this SLR rate with them. Okay, again the impact will be similar. If the rate is increased or decreased, the money supply will be impacted similarly like happens to CRR or in case of repo rate or reverse repo rate. So it will develop or decrease the development in the economy. Okay, then there is repo rate. Repo rate is very important because in terms of home loan buying and other things, the repo rate gets impacted because it's the rate by which a bank takes money from RBI at what rate of interest, right? So if this is decreased, bank indirectly decreases the rate of interest for the consumers. Okay, so you might be hearing that the repo rate has RBI has cut down repo rate by say 100 basis point, 50 basis point. Okay, so what is this? Basically, they are cutting down our rate or increasing the rate. So this is also a tool to increase or decrease the money supply in the economy because it will indirectly, because if the interest rate is too high, people will be hesitant to take loan and people will be hesitant to buy homes, right? So this will indirectly decrease the demand in the economy. Okay, then there is reverse repo rate, which is called which comes into picture because of uh, you can say RBI taking money from the banks. Okay, so whenever RBI if you are keeping the money right now, when you are keeping your money in the bank, so bank is taking money. So bank, what does you it gives you in savings account? It gives you 3.5%, right? So similarly, when RBI wants the money and it takes it from the bank, or bank keeps it money with the RBI, so it is called as reverse repo rate. Okay, so it impacts, like I explained, if the repo rate is decreased, it indirectly is passed on to the consumer by banks. The rate of interest is decreased, and a lot of demand gets created because rate of interest is less. So there's a lot of money that business takes and people take to buy homes, business take to flourish their industry, and economy gets flourished. Okay, uh, so this is what happens when repo rate is increased or decreased. Then there is bank rate. So whenever you take loans, you give certain security, then the rate of interest is decreased. But what if you don't have securities with you, right? So similarly, when bank doesn't have securities with them, they take the loan from the RBI. Okay, so that rate of interest is obviously greater than the repo rate. Okay, because there is no securities involved. Otherwise, then there is GSEC bonds and other government T-bills, which uh, is, you can say, bank pledges to take the money from RBI. Okay, so there's impact again. Bank rate would be the same like repo rate. Okay, then there is marginal standing funding, which is, you can say, an emergency fund that has to be taken by the banks by RBI. So whenever there is certain rates increased or decreased by the bank, so if the banks are short of funds at that point of time, so you can even take loan from RBI for even a single night. Okay, but you need securities and you can only take 1% of whatever you have pledged. So that rate of interest is called as marginal standing funding. So MSF rates. Okay, so that RBI also gives it as a opportunity to banks to for overnight maintaining their balances and funds. Okay, so and then there are open market operations. So open market operations is nothing but buying and selling of government securities in open market. Okay, so whenever government is printing money, it releases T-bills, or there are certain government securities for printing money or other purposes, right? So because it has to be, whenever they are printing money, it has to be backed by some or the other security, right? So RBI, what at that time does is that it buys it back the T-bills and the securities. So this process is called as open market operations. So whenever there are selling and whenever there is buying in the open market operations by RBI, it has some impact in the economy, right? What will be the impact of when they are purchasing securities? Obviously, when they are purchasing securities, that means they are supplying the money in the economy. That means that there is more demand and it will indirectly lead to high growth because there will be more funds for businesses to flourish, right? And then if the governments are selling these securities, that means that obviously government doesn't have that money with them to supply to the economy. So that means that there is less money in the economy, obviously, which can't be passed to the businesses, and their rate of interest is too high because there's less money. So demand will be less and the prices will be very low. So overall, whenever you see inflation and other things in the news channels, so that means that RBI is doing some or the other thing to maintain a balance or equilibrium in the economy. Okay, so let me just give you the current rates that are available in the market. Its repo rate is at currently at 6%, reverse repo rate is 5.75, bank rate is 6.25, MSF is at 6.25, CRR is 4, and SLR is 20%. So these are currently the rates that are being used by RBI. So this has been, if you have been following this RBI rates, you might have seen that this has been tremendously declined from 8% to 6% right now. So that means that the economy is doing good. So whenever the economy is doing good, they will be decreasing the rate of interest for the banks, and also which has been passed to the consumers by the banks. But if inflation takes place and things get very high priced, then what bank needs to do? Bank needs to increase the rate of interest, which will create less demand in the economy. Okay, so these are the major policies and tools used by RBI to maintain the economy and manage the economy. If you have any queries, please you can write down to me on investransresearch@gmail.com. And please subscribe to this YouTube channel for more videos. You can also like our Facebook page, Investrance Research. That was from Investrance Research.